Hi guys, welcome back to my YouTube channel. This is Mombo, your future CFO. And today we're going to be looking at how you can analyze the balance sheet to check the health of the balance sheet. You know, accountants are doctors in their own field. We treat the figures to make sure that they show the actual position. Anyway, that was a commercial break. Let's dive in. Let's get started. Let's see how you can analyze the balance sheet. Thank you, guys. Let's get started. So the first thing that you need to do before you analyze your balance sheet is to check if your balance sheet is it's balanced. You check if your total assets equals your equity and liability, the accounting equation. Total assets equals total liabilities plus equity. That is the basic accounting equation. And we say once you've learned that, it's like you've learned like half of the accounting. So that should be the first thing that you check. And the example that we're going to be using, our total assets are $1.74 million, and our liabilities and equity 1.740 dollars. So our assets and our liabilities and equity are balanced. So guys, we're good to go. Let's now get started. That is the first check that you do. If it's not balanced, you know there is a problem. First, you need to solve the problem before you get it done. But in our case, we are good to go. So it's time now to learn how to do the analysis, how to check the financial health of your balance sheet. So I'm going to be showing how to analyze your balance sheet. And here we're going to be using the assets, the totals as our base. So we want to know our cash and cash equivalent. What is the percentage of the base? And everything is expressed as a percentage of the base. So I'm going to fix. And fixing, you just add a dollar sign before the denominator. So I want to see how we're doing as an organization as a whole. So our cash and cash equivalent is 9% of our total assets. Our marketable security, 6%. Our accounts receivable net of provisions, 14%, inventory 7%, prepayment 3%, non-current assets, this is PPE, computers, properties, motor vehicles, among other assets the organization is holding. We're going to do the same for the other side, the side of liabilities and equity. Everything we're going to express as a percentage of the total liabilities and equity, which is the same as our total assets. I'm going to fix it again to make sure that we do it very fast. You just need to fix, then you drag down to get the different line items. So our total liabilities are 53% of our total assets. Our common shares, 17% of the total assets. Our retained earnings, 29% of our total assets. So that is how you do it, guys. Let me show you another way you can use to know, to also analyze your balance sheet. Then now, once you've done that, you are able now to compare what does the capital structure of the organization say about the different sources of finances. We know we have the three sources of finances. We have debt, the preferred shares, and the common shares. What does the company policy say when it comes to the capital structure? Are we in adherence? So those are the things that you will now be able to compare once you've gotten the percentage. Another thing, you can check the growth from one period to the other. You want to see how your assets have grown. Like our cash and cash equivalent has grown by 30,000 from one period to the other. So I'm gonna get the totals all the way down to the total equity and liabilities. That I want to see the growth from prior periods to current period. How did each line item grow? So I'm gonna get my growth divided by the prior period, the figures of the prior period. So our cash and cash equivalent grew by 23%. And I'm gonna now drag it down to get the different growth rates of the different line items all the way down to the totals of equity and liabilities. Then I'm able to know exactly what is happening to the different line items. For example, our marketable securities have grown by 100%. We've invested more on marketable securities. Maybe the interest rate is good. We're generating more returns. That is the reason why we doubled our investment in marketable securities. Our accounts receivables, they've grown up by 39%. We need to check what is happening here. You know, the more accounts receivables are outstanding, the higher the credit risk, the higher the risk of collecting them. So we need a schedule to see, an aging schedule to see how long these accounts receivables have been outstanding and follow up on the accounts receivables that are overdue. Inventory. Our inventory has gone down by 7%. It shows that we are able to turn over our inventory. We are able to convert more inventory into cash, which is a good sign. Our prepaid expenses, we've prepaid less. It's a good sign. So cash is not held on the prepaid expenses. Our current assets, non-current assets, our current non-current assets have grown by 9%. Maybe we acquired more fixed assets. They also called fixed assets, the PPE. Maybe we bought a new motor vehicles, we bought more computers, we bought more furnitures. That could be the reason why they are growing. Our total assets have grown by 12%. So we've grown our total assets. We've invested more on, we've grown our assets by 12%. Our current liabilities have grown by 20%. We know the longer it takes to pay liabilities, especially the current liability, the better for the organization. We are able to, it increases our liquidity as an organization, but what does our policy say? We need to be adherent to the policy of the organization. If the policy says we need to pay our payables within let's say 45 days, we need to pay. So something that we need to check. Our non-current liabilities have also grown by 2%. Maybe we got a new facility, a new loan. We got another bank loan from our lenders. That could be one of the reasons. So our total liabilities have grown by 80%. Let's check now the common shares equity. 0% growth on the common shares. We did not raise money through common shares. So the figure is still the same from prior period to current period. Our retained earnings have grown by 32%. This is attributable to growth in profits, net of dividends paid. And maybe also we could have used our retained earnings to make investments. We're doing some capital investments as an organization. That could be one of the reasons why we are pulling resources from our retained earnings. So our retained earnings have grown by 32%. And in general, our total liabilities and equity have grown by 12%. So as a company, we are growing our assets, and in turn, we're also growing our liability and our equity. Guys, that is what I had for you when it comes to analyzing the balance sheet, to know the financial health of your balance sheet. So every percentage you need to dig down, you need to understand. You need to know exactly why there is a decline, why there is an increase. It's important. That way you are able to know if every line item is supposed to be, it's reported the way it's supposed to be. So thank you for your time, guys. Thank you for watching me all the way to the end. Thank you for staying with me. And if you've learned something new from this video, make sure you subscribe. Hit the button, hit the notification button, subscribe to my YouTube channel to get notification on future videos that I am posting on my YouTube channel, guys. Thank you for your time. Thank you for staying with me all the way to the end. I'm sending a lot of love. You guys are the best. You are the best. Thank you. Thank you. Be blessed.